Well, hello. Now we're back to the normal routine here for the next couple of weeks. Well, normal as far as normal gets, I suppose. Um, what we're going to be looking at today is something called the loanable funds market. The loanable funds market is where all the financial activity takes place. Well, most of the financial activity. The loanable funds market is or involves a very simple equation. Actually, I don't even know if I would call it an equation, but it is this relationship that has to exist in order for there to be economic growth. If you don't have this relationship, if you don't have this activity going on, then economic growth is nearly impossible. So we're going to take a look at that special relationship to begin with. And then we're going to look at some of the pieces of the loanable funds market. Some of these things you probably have heard of before. In fact, I would venture to say at least two-thirds of them you've heard of before. We're going to introduce at least the idea of banks and the role that banks play. We're going to talk a little bit about the stock market. And we're going to talk a little bit about the bond market. Now, let me give this one disclaimer going in ahead of time. I'm going to talk about these things. I am not going to give you advice about how to save your money and about what stocks to buy or about what bonds to buy. As I will get into in excruciating detail, I'm a horrible stock picker. So whatever I say to do would do you no good at all, and it would probably lose you money. So I'm going to talk about the basics of these things, but I'm not going to tell you how to make millions in the markets. So with that in mind, let's get into the loanable funds market. So here we are, the loanable funds market. And it's really important to make this one point. Without a loanable funds market, the future gross domestic product is going to dry up. When we talk about loanable funds, we're basically talking about the process by which people who are going to invest in businesses get the funds that they need to invest. And if investors, and I want to be really careful about what we're saying here. Investors are businesses. Investors are small businesses, large businesses. Remember the definition that we had of investor in the in GDP. Investors were the business people, or the investment is the purchase of the things that you need: the machinery, the capital, the tools, the resources that you need to expand your business. And that's what we're talking about here when we're talking about investment. We're not talking about you saving for your retirement or talking about you day trading or doing any kind of buying of stocks and bonds to make yourself wealthy. Investment is business buying the things that businesses need to expand their business. And if we don't have people doing that, then we're not going to have the new things that we need to, or the new things that we get to make life more interesting. We're not going to have the iPads. We're not going to have the electric cars. We're not going to have the, we're not even going to have flight. We won't have people flying around in airplanes or using cell phones. We don't have that stuff if there's no investment. And we don't have things like cures for coronavirus if we don't have investment. Businesses need a pool of funding so that they can expand what they do. Okay, so I told you there's a key equation, something that is really not an equation so much as showing a relationship. And, oh, who's the dog? Oh, that's my dog. That's my dog, Lucy. And nothing connects something to your memory better than a cute dog. So this is Lucy. Think about Lucy. If she could talk, what she would say. She'd say, "This is a really important thing to remember." When we talk about the loanable funds market, the most important relationship, the most important concept upon which all of this is based is this: S equals I. And S equals I is the thing that if you grasp this part of the loanable funds market, then things pretty much make sense from here on out. S equals I. Every dollar borrowed requires a dollar to be saved. So what we're talking about here is S is savings. S is savings. And I is investment. And you need savings if you're going to have any investment. Without any investment, without any savings, there cannot be investment. So if you're going to borrow money to expand your business, there has to be savings first. And the savings is where we come in as households. The businesses are doing the investment, but they depend upon us to have any savings. So think about this. Lucy says, if you don't have any savings, you cannot have investment. Lucy says, if you want to understand the loanable funds market, you need to understand this equation. Savings equals investment. So what does that look like? Well, in order to understand how those two things fit together, we have to understand the pieces of the loanable funds market. The first piece is the interest rate. Now, because this is a market, there are pieces that are similar to any other market that we look at. And in the case of the loanable funds market, the interest rate is the price. This is the price to investors. So this becomes the cost to the investor. The people borrowing the money, the businesses, they have to pay the interest rate. And this is also income to people who are saving. So if you save money, you put it in a bank, for example, and you get paid an interest rate, that becomes income to you as the saver. So let's say that you put $1,000 into an account that gets 4% interest. Well, that means that you have income of 4% of the $1,000 or $40. So what we've done here is we've just taken the $1,000 and multiplied it by 4%, which is 0.04, and we get that $40. But the investor has to pay an interest rate as well. And so for the investor, we're going to see that that becomes a cost. But for the saver, we can think about the interest rate as the opportunity cost of consuming today. Let's say that you go and, let's say that you are bequeathed $1,000. So that means, some great rich uncle of yours has passed away. You've never met the person. There's no emotional connection, and they give you $1,000. And so you could do what you want with that $1,000. You could go out and have, go out and buy, some nice clothes. You could take your friends out for a really, really nice evening. You could, well, I guess there's not much you could do with it right now that I think about it. But you could do something with it. Let's say these are normal times, and you could go out and you could have some fun with the money. Or you could put that money in the bank. And so if you decide to go out and have fun with that money, then you are giving up the opportunity to earn that $40, earn that interest. And because you're giving up that opportunity, we say that the interest that you could earn is the opportunity cost of consuming that money or spending that money today. So savers have to think about this. What could I be doing with my money? Well, I could be doing any number of things, or I could save it and earn interest. Oh, but if I spend it, then I don't earn the interest, and that's an opportunity cost. And as the opportunity cost goes up, as the interest rate goes up, the opportunity cost of spending goes up. The opportunity cost of consuming your money today goes up. This is what sometimes we refer to as the rate of return, or the ROR, the rate of return. The rate of return just tells you what you earn on when you save that money. And so the rate of interest is the rate of return, what you get back for saving. So that's kind of the basics of interest rates. So interest rates are also costs to the investors, as I mentioned. If you borrow at 4%, it means that to borrow that $1,000, they have to pay not just the money back, not just the $1,000 back, but they also have to pay that interest. They have to pay that extra $40. So your investment better earn at least $40 or it's not worth it. Basically, this is a cost-benefit calculation, or comparing the margins. If the marginal revenue is greater than the marginal cost, meaning the marginal revenue is whatever you're earning in your business. The marginal revenue is essentially the rate of return. And so we're going to compare the marginal revenue, that rate of return, to the marginal cost, which is the interest rate. So what's the relationship between these two? If the relationship is that the marginal revenue is greater than the marginal cost, then good, go ahead with the investment. But if the marginal revenue is less than the marginal cost, in other words, if the rate of return is less than the interest rate, then you're going to have a hard time justifying investing your money in a particular way. And as the interest rate rises, it becomes harder and harder to justify any investment. So think about it this way. If you have an investment that's going to have a rate of return of, say, 6%, and the interest rate is 1%, there's a lot of potential investments that would make sense. In this case, the rate of return is far in excess of the interest rate. You could even say, well, I've got a project that has a rate of return of 3% or even 2%, and you could justify that based on the numbers. But if the interest rate goes up, let's say the interest rate is 7%, well, now this thing over here, whatever your investment was, whatever your investment plan was, it doesn't make sense anymore because the rate of return is below the interest rate. And so are any projects with a rate of return of 5, 4, 3, 2, or 1.5%. Those things used to make sense when the interest rate was very low, but now they don't. Today, the interest rates are really, really low. So there's lots of investments that would make sense, that a business could justify. And this in part has to do with policy that's been enacted to try to keep interest rates low. We'll talk more about policy next week. But the takeaway here is that interest rates dictate which investments will go forward, because if the interest rate is high, it's less likely that a project will go forward. If the interest rate is low, then lots of projects have the potential to work. But you have to be careful about inflation. Inflation is that macroeconomic statistic we talked about a couple of weeks ago that revolves around the value of money. Now, banks offer you a nominal interest rate. The nominal interest rate is the advertised rate. It's the interest rate that they say, hey, this is the interest rate you will pay. or this is the interest rate you will receive as a saver. But you have to be careful about inflation, because inflation erodes the value of your money and it erodes the value of your income. So let's say you are saving money and you are promised an interest rate of 5%. So you're thinking, if I save $1,000, I'm going to get $50 in return. But inflation is 1%. That means prices are going up by 1% per year. Well, your real interest rate is then 4%. And that means that the value of the money that you earn in interest, so that $50, once you collect the interest, it can only buy you $40 worth of stuff, because interest is paid over time. So if we have a nominal interest rate of 5% and inflation is 1%, then this 4% is really this is the true value, or the true change. This is the true change in the value of money, or in the value of your interest. So you think you're earning $50 and you earn 50 nominal dollars, but the value of that interest you have earned is only $40. But what if inflation is surprisingly 10%? Well, you're putting your money in the bank expecting to earn $50. But because prices go up by 10% more than your interest, then your real interest rate is actually negative. It's negative 5%. And what this means is, if you put your money in the bank and inflation is higher than the nominal interest rate, then when you take that money out of the bank, it's actually worth less in terms of spending power. Which means savings is not a good idea. It's not a good thing to do with your money. You're better off just going and spending it. This is something we talked very briefly about when we talked about hyperinflation. Basically, banks could not keep interest rates high enough because inflation was rising so quickly. And so nobody put their money in the bank to save it, because if they did, the value of that money when they take it out of the bank is worth less than when they put it in. They can't buy as much. So you've got to be careful about inflation. Now, inflation is bad for the saver, but it's good for the borrower, because if the borrower is repaying money that's worth less than when they borrowed it, that's outstanding for the borrower. So whether inflation should be feared or not depends upon whether you're a saver or a borrower, whether you're a saver or an investor. Okay, now let's talk about where you can do your savings and where you can do your investing. There are two different ways of looking at savings and investing. One of those ways is the direct way. And the direct way gets savings directly into the hands of investors. The direct method are the stocks and the bonds, the stock market and the bond market, because really what's going on is that savers are giving their money directly to investors. They're saying, hey, look, companies, I know you want to invest. I have money to help you invest. Here it is. That's the direct way of getting savings into the hands of investors. And we'll talk more about the specifics of stocks and bonds here shortly. Again, this is you giving your savings directly to the investor. The indirect way of getting savings into the hands of investors is through the banks. When you give your money to a bank, the bank acts as a go-between between you and the investor. Because remember, you're the saver. Let me show you what that looks like. When we're talking about indirect, methods of getting savings into the hands of investors. You've got to have someone in between. You need a middleman, and the middleman is the bank. So here's what that looks like. Here's you. And you're walking along, minding your own business, and you look down, and there is, say, a $20 bill on the ground. And you look around, there's nobody around. There's no way to tell who this money belongs to, so you pick it up. Very wise move on your part. You understand that somebody has dropped this, and so to prevent that mistake, you go and you're going to put that money into a bank. This is a bank. It is not a jail, even though it might look a little bit like a jail. This is a bank. And so you take this money, you take it up to the teller. They say, hey, how you been? I haven't seen you around here for a while. And you say, hey, I've been great. I found this money and I want to deposit it. And the bank says, that's fantastic. We're very happy to take your money. We're here to serve you. And so you put your money in your checking account or your savings account. It doesn't really matter. And the bank says, thank you very much. You walk out the door, and right as you are walking out the door, somebody is walking in the door. We'll say it's this person right here, and we'll give them a nice top hat to make them look like they're very important. And so this person walks in and they say, why, hello, I would like to borrow some money for my business. And the bank says, it just so happens that we have money we are able to lend to you. It just so happens that the money that they're going to lend to this person is the money that you deposited in the bank. And that's what makes the bank the middleman. You put your money in a bank. Now the bank pays you an interest rate. And the bank takes your money and lends it to this guy in the top hat. Now this guy in the top hat pays the bank an interest rate to borrow the money. So basically what the bank is doing is they are lending your money out. They're acting as a middleman. Instead of you lending the money to the business, because that's what this guy is, he is a business person. Instead of you lending your money directly to the business, the bank works as the middleman. They take your money and my money and whoever puts their money into the bank, and they lend it to businesses. Of course, the bank has to pay you to provide an incentive for you to save your money, and the business needs to pay the bank an interest rate because the bank needs an incentive to lend the money. And so what happens is the bank makes a nice tidy profit because the interest it pays you is less than the interest the business pays the bank. And that's banking basics. It's banks working as a middleman in between the savers, and that's you over here, and the investor, which is this business over here. That's how the bank works. That's how the bank works as this indirect way of getting savings into the hands of investors. Okay, so let's take a look at each one of these pieces in a little bit more detail. The first is the savings. Savings is the supply in the loanable funds market, the market by which we get savings into the hands of investors. And as we talked a little bit about before, just very briefly, when the interest rate goes up, it becomes an opportunity cost to you for not saving. So the interest rate is the price, and because it's the price, if the interest rate goes up, it's going to work just like any price in any market, and it's going to have an impact on the quantity supplied. At higher interest rates, people have a tendency to save more because they're getting paid a higher return for savings. I remember my wife's grandmother was always wondering why she didn't have more in savings. Not because she was spending the money, but because it wasn't a good place for her to put her savings. She remembered back into the 70s when the interest rates were really high. So you put your money in savings accounts. But in her later years, the interest rates were much lower. So it didn't make sense to put money in a basic savings account, because when the interest rate goes down, the quantity supplied goes down. It doesn't make sense to put your money in a bank account if the interest rate you're earning is 0.5% when there are alternatives. This, of course, is just the law of supply applied to the loanable funds market. So when the interest rate changes, it changes the quantity of savings supplied. But what happens if something else changes? What's going to cause the supply of savings, the supply curve, to shift? What affects savings? Well, there's a lot of things that affect savings. The most obvious would be a change in income. If your income changes, if your income goes up, it allows you to save more. This is why we see more savings in rich countries, because people have more to save. They're not worried about, oh, how am I going to put food on the table? Then this causes the amount of savings to change. And this is going to be one of the problems going forward for the macroeconomy of any country affected by this coronavirus, because people lose their jobs, they have less income, so they're going to save less, which means there's going to be less for investment, which will have a long-term impact on GDP. A change in attitude can affect how much people save. For example, one of the things that we look at when we look at savings is the attitude people have towards how they spend their money over their lifetimes. It's something we call consumption smoothing. Think about it this way. Over the course of your life, you save differently. So here we're just looking at money over time. And when you are very young, really you have no money, and so you're not saving any. And then gradually over time, you earn more money. And then as you age, you earn less money. So think about this black line here as your income. This is your income over time. But if you were to spend the way you earn, then life is going to be kind of awful at the beginning of your life and at the end of your life. Instead, people tend to consume more like this. So the black line is your income, but the green line is your consumption. You smooth your consumption over time. So when you're young, in this part of your life, you are doing what we call borrowing. You borrow money to go to college, you borrow money for a car, you might borrow money for a house, you use your credit cards, you might borrow money from your parents. You don't have enough income, really, to satisfy all the things that you need. At the end of your life, you're doing something a little bit different. You are doing what we call dis-saving. Hopefully you've saved some money during your working years, and now you're living off of that savings during retirement. But this time period in here, where your income is above consumption, this is really the time in your life where you're saving. So you smooth your consumption. So when you don't have as much income, you borrow, and then you hopefully pay the loans back, and you save money for your future, and then you dis-save during your retirement years. So that's what we mean by consumption smoothing. And that's certainly one attitude that people have towards savings. If they view their lifetime consumption as opposed to what's going on immediately right now, then people change the way they approach savings. The other difference, the other sort of attitude change involves something called time preference. When we're talking about time preference, we're talking about what is your preference for spending? Is it immediate or is it something that you can forego? If you have a very high time preference, then you want things right now. Give it to me now. I've got to have it now. I can't wait. I'm not going to wait. I shouldn't have to wait. Those are people with high time preferences. And we talked a little bit about high time preferences when we were dealing with behavioral economics. Low time preference is the person who can be patient, the person who can wait. People who save and save a lot tend to have a low time preference. They don't consume a lot now because they're putting money into their savings. So when we talk about savings, these are the things that primarily affect the position of the supply curve. Changes in income and changes in attitude. So here's what we mean when we talk about supply shifting. So here's quantity. And remember, this is the loanable funds market. So we are looking at the quantity of loanable funds, and this would be our price. At least it would normally be our price, but we don't call it the price. This is called the interest rate. So if we have our supply curve here, and say people's incomes go up, or there's a change in attitude about savings, a positive change in attitude, so that there is more of it, our curve would shift to the right. Again, this is an increase in supply. And if there's a decrease in income, or people's attitudes turn negative towards savings, then we would shift that curve to the left. This would be a decrease. A decrease in savings. So that's what happens when the supply curve itself changes. Okay, so now we're on the demand side. Demand comes from investors, the people who are looking to expand their business. Remember, this is not you, this is a business. And so if there is a change in the interest rate, then that's going to have an impact. So if the interest rate goes up, it's just like any other price. The interest rate rises, then the demander says, oh, things are getting more expensive. And so the quantity demanded will go down. And if the interest rate goes down, then investors look at that and say, oh, borrowing money is cheaper. I want to do more of it. This is just, again, the law of demand, but now it's applied to the loanable funds market. So if the interest rate changes, it's going to have an impact on the quantity demanded, which means we move along the demand curve. But there are other things that can cause the demand curve itself to move. One of those things is the productivity of capital. So if a business is borrowing money to expand its capital so that it has more machinery, tools, whatever it needs to produce the things that it produces, then if that capital becomes more productive, it basically says that, hey, the things that I buy give me a bigger return, and so I want to do more of this. So if the productivity increases, that means the rate of return increases. So you're going to borrow more at any interest rate. The other thing that affects investments significantly is investor confidence about the future. So investors look out across the landscape and they say, oh, this is a good environment for me to invest because in the future people are going to want to buy the things that I'm producing. Right now, investor confidence is kind of low, but it can turn around fairly quickly. It changes in investor confidence about the future. If you think the future is looking really great, then you want to invest more. If you think the future looks kind of shady, then you're going to invest less. So just to take a quick look at that in terms of the curves themselves. So again, let's take a look here at the demand curve and look at the demand curve shifting. Again, we're looking at the market for loanable funds. So quantity goes along the horizontal axis. That's just how many loanable funds we're demanding. And then we have the interest rate over here on the price axis. And here's our demand curve. And if, say, investor confidence increases or the productivity of capital increases, we're going to shift the demand curve to the right. That's our increase in demand. And if there is pessimism about the future, if productivity of capital isn't increasing, then there is a decrease in demand. And that's shown by a shift to the left. So just like we've always seen, a shift to the right is an increase, a shift to the left is a decrease. Okay, so let's put these parts together now, the demand and the supply in the loanable funds market, and see what that looks like. It's really, really simple. It looks like just about any other market that we've seen in this class before. We're just going to find where the two lines cross, and that's going to set up for us the market equilibrium. And here's what that looks like. Once again, we start with the familiar setup of quantity along the horizontal axis, our price along the vertical axis, but of course our price is the interest rate. Here's our supply curve, and here's our demand curve. We look to find where those two lines intersect, and that gives us the equilibrium interest rate. We'll call that IR and put a little star there. And this is just the equilibrium quantity of loanable funds. From here, things work just like any other market. If there's a change in demand or a change in supply, we'll see those changes in the interest rates. So, for instance, and we're just doing this all ceteris paribus, or ceteris paribus, remember. So this is just one change at a time. Let's see what we should expect to, let's kind of investigate what we should expect to see in the loanable funds market as a result of people losing their jobs, as a result of incomes falling. Well, if income goes down, that's going to affect which part of the market, supply or demand. If you said supply, give yourself a cookie. Supply is the savers, and if incomes go down, it's going to affect how much people save. So which direction does the curve shift? Well, hopefully, if you remember that if incomes go down, people save less, and saving less means that you shift the curve to the left, which would give us a new equilibrium right here. And that results in a higher interest rate. And it results in less lending, a smaller quantity of loanable funds being borrowed and being saved. So this is a real concern at the macro level. If people lose their jobs, and some of the unemployment rates that I've been hearing tossed around are remarkably frightening. If unemployment goes up by as much as people fear, that's going to cause a big shift in the savings, and it's going to cause this result. Now, that's bad because if interest rates go up, then people will borrow less, which means investment goes down, which hurts GDP. So we're going to see when we move into monetary policy that the Fed, the Federal Reserve Bank, is going to try to do something to keep these interest rates from going up. So there will be another change in the loanable funds market, but for now, this is what we should expect to see happen. Okay, so those are the basics of the loanable funds market. Those are the pieces that we put together, and we're going to spend a lot more time talking about banks over the next week or so. So what I'm going to do is I'm going to kind of move away from the banks for now, and I want to talk about the basics of the stock market and the bond market. These are definitely components of the overall loanable funds market or the overall financial system. These are the direct ways we get savings into the hands of investors. So I want to take a look at those specifics. You probably know a little bit about, well, you may know a little bit about the stock market. You probably don't know that much about the bond market. So let's take a look at each one of those in turn. We'll probably spend a little bit more time with the bond market because there are a few more specifics about the bond market that are easy to follow. And the stock market is, at least we'll get the generalities of the stock market as we move forward here. Okay, so let's first of all take a look at the stock market. The stock market of these direct ways of getting savings into the hands of investors. So remember, the bank was the indirect way. The stock market and the bond market are direct. Of the two, the stock and the bond market, the stock market is by far the more interesting. If you ever see a movie that deals with the loanable funds market, it's probably talking about the stock market, whether it's Wall Street or Wolf of Wall Street or Trading Places or any of these movies that talk about the markets. They almost always talk about the stock market, not the bond market. In the bond market, the B stands for boring. The stock market is way more exciting. There's lots of, at least it used to be, when you could watch the traders on the floor of the New York Stock Exchange, it just seemed like utter chaos and bedlam and fun. The stock market itself isn't all that interesting as far as the pieces of it are concerned, but there's the potential to have significant returns, significant gains for the people who buy the stock. So let's talk about what the stocks are and kind of the different type of stocks that we have. So first of all, let's talk about what stock is. Stock is what we call equity ownership. It's equity ownership. And what this means is that when you buy stock, you are buying ownership in a company. So if you buy Microsoft stock or Facebook or Starbucks or Ford Motor Company, you are becoming an owner in that company. And by becoming an owner, you have certain rights and responsibilities. As an owner, you get certain votes on what is going to, kind of how the company is run, not on the day-to-day operations. But stock is equity ownership, and as an owner, you get certain rights. You get a vote on the board of directors. This is the primary vote that you have. You get a vote on the board of directors. Who's going to run the company on the day-to-day basis? As an owner of the company, you get a say in that. But it's important to understand that your vote is only as good as how many shares of stock you own. Because it's not one person, one vote. It's one share of stock, one vote. And 2 shares of stock, 2 votes. So the more stock you own, the more votes you have. I used to own Microsoft stock, and whenever I had the chance to vote on who would run the company, I would always vote against Bill Gates, just because I could. Not that I have anything against him, not that I thought he was doing a bad job running my company, but I just thought, hey, I've got 10 shares of Microsoft stock. If he gets 10 fewer votes, he'll never even notice because he has millions of shares, and I'm sure he votes for himself. But as an owner of the stock, I got to vote on who would run the company. And that's one of the more important things that you have to say as far as the owner. There's another important thing that I'll mention in a few minutes, but I want to talk a little bit more about the market, kind of the basics of the market itself before we get to that. As far as the stock market itself is concerned, there are a couple of other things that are important. One is that whenever you buy stock, you are almost always, in fact, I will say probably in your lifetime, you will always be buying stock that somebody else has owned before. Buying stock is just basically a huge garage sale of people selling things that they've owned that they want to get rid of. Whenever you buy stock, you're buying it from someone who has owned it before, and probably they've bought it from someone who's owned it before, and they have bought it from someone who's owned it before. When it comes to the business getting money from the stock, and remember, this is the purpose of selling stock. The purpose of selling stock is to raise money for the businesses. It's not so that they can see their name on the New York Stock Exchange. The purpose of selling stock is to raise money for investment. So the company says, we're going to sell stock. And when they sell it, it's called an initial public offering. Or what is called more commonly an IPO, an initial public offering. This is the first time the stock is sold. And it's usually sold to big investment companies. They buy huge quantities of stock and then they sell it to whoever they want to sell it to. But the only time the company gets any money is when they have this initial public offering. So if Facebook's initial public offering price is at, say, $50 a share, if they sell 1 million shares, that means they get $50 million. If the price of the stock goes up after that, Facebook doesn't see any more money coming into their coffers. Mark Zuckerberg might, because he owns a whole bunch of stock. But the company only gets money at the initial public offering. After that, the price of the stock is set by the market. The price is set by demand and supply. And so basically what's going on is that the price of the stock in the stock market is just subject to this. Now the supply tends to be fixed. And so it's the demand that helps set the price. If the demand goes up because people think the company is worth more than it's selling for, then the price of the stock will go up. So the price in the market is set by demand and supply. And essentially what people are looking at is what's their expectation of the future for the company. If you think the future is good for the company, then the demand for the stock is going to go up today. And if you think the future for the company is bad, then the price of the stock is going to go down. This is one of the reasons why we saw so much volatility in the stock market over the past month or so. People looked out into the future. They saw all of these people being told not to leave their homes, and some companies' stocks just tanked. They tanked because if, say, you run a department store and people are not allowed to go shop, well, the expectation of the future of that company is going to go down. And so the price of the stock is going to go down. Okay, so those are some of the basics of the stock market. Let me just mention a couple of things about stocks themselves. So when we look at stocks, kind of the way that people look at stocks are in two different categories. You have one thing that's called an income stock. Income stocks tend to have a little bit less volatility in terms of price. Prices don't go up or down all that much. The way you make money buying an income stock is through that second major benefit from being a stockholder. So the first benefit is that you get a vote on who runs the company. The second major benefit is that you can earn money just by being an owner. That money is referred to as a dividend. A dividend is a sharing of the profits of the company with the owners of the company. A lot of companies, a lot of businesses pay dividends. So maybe every year or every 6 months or every 3 months, you get a check basically said, hey, we made this much money. You get some of it as an owner of the company. Those are dividends. And if you own a lot of shares of stock in these a lot of these shares of income stocks, you can earn a pretty nice income stream. Dividends are taxed, but they're taxed at a lower tax rate than most income. So dividends can be a great way of earning income for yourself. Income stocks pay dividends. They have less price volatility. So you're typically not going to make much money by buying low and selling high. Instead, if you want to buy low and sell high, and this is kind of the excitement of the stock market, you would buy what's referred to as a growth stock. Growth stocks, this is the typical buy low and sell high. The old adage in the stock market. Great advice if you follow it. You buy a stock at a low price and then you sell it at a high price. That's how you make money with growth stocks. So you get in on the ground floor of a company and you buy at a low price, and then the price over time goes up and you sell it at a high price. Maybe that time period is over a number of years. For example, I've owned Apple stock for like 10 years, and the price has gone up over time, and I'm very happy about that. But I don't get any income from Apple. I get a little dividend from Apple, but I don't get any income from Apple until I actually sell the stock. If I hold on to it, it doesn't really matter how high the price goes. Growth stocks, you buy low, you sell high. Oftentimes, if they pay a dividend, they pay a small dividend. These tend to be companies that just pour any profits right back into the company to try to grow the company. So you have income stocks and you have growth stocks. Now, the thing that you need to be aware of no matter what in terms of stocks is that when it comes to trading stock, there is a lot of risk involved in trading stocks. Some stocks are just stories of immense success. For example, Amazon traded, when it opened to trade back in 1997, it traded at $23.62 a share. Even today, after all of the ups and downs of the market, the Amazon stock is like at $1,800 a share. If you bought a bunch of Amazon back at $23, you're incredibly rich right now. But not all stocks are like that. Sometimes people buy stocks at the high point and then the price of the stock goes down, in which case people lose money. So whenever you're trading stocks, after the initial public offering, trading stock is kind of like legalized gambling. You're just you're trying to find a stock at a low price and sell it at a high price, or you're trying to buy. If you're doing income shares, it's a lot less risky, but there is still risk involved. You buy a stock at a price and you collect the dividends, and you don't worry about the price of the stock going up or down too much. Irregardless of what kind of stock you buy, there is risk involved, and to be serious about this, you can lose a lot of money if you buy stocks that go down in value, and there are plenty that go down in value. For example, if you would have bought a bunch of stock at say in the middle of February of this year, you would be really sad right now. You buy it in February, and today this is what you look like. Because the value of stock has gone down so much. Hopefully the stock prices will go back up at some point in time, but right now things are pretty bad. If you want to avoid the risk, maybe what you ought to do is go to the bond market. Because the bond market while it is much more boring, it's also considerably safer. Bonds are another way to get savings into the hands of investors. Basically, here's how it works. Here's you, and you have some money. And here is a company over here. And they want your money, and you give it to them. Now, you may say, well, that seems foolish. Why would I give them my money? And the answer is because in return, they give you a bond. A bond is nothing more, really, than an IOU. It's a promise to repay you the money that you lent. But they're going to repay you with interest. So, just like when the bank pays you an interest rate, when you own a bond, you're getting paid an interest rate. Now, there are different kinds of bonds. There are government bonds. So this is when governments lend money, when governments borrow money, and governments borrow lots of money. And there are what we call corporate bonds. Corporate bonds are when businesses borrow money. I'm not going to really pay too much attention to the difference between these two. We're going to focus our attention mainly on corporate bonds for now, because corporate bonds are how investors get money. We'll talk more about government bonds when we talk about the Federal Reserve Bank. But in this case, since we're talking about the loanable funds market, we're talking about how businesses acquire savings so that they can invest. Now, how much interest you get paid is going to depend upon risk. There is risk involved here. Risk determines the interest rate. But the risk we're talking about here are much more formulaic kinds of risk. They're much more straightforward kinds of risk. So what are we talking about when we talk about risk? There are actually three types of risk when we have a bond, but I'm getting ahead of myself here. Let's first of all talk about the parts of a bond. A bond is just a piece of paper. It's just an IOU. But on the bond, you have certain information that's really important. One of the things on the bond that's important is something we call the par value. The par value is the par value is the face value of the bond. Or maybe another way to describe this would be to say that the par value is the amount that you get paid when the bond matures. So this is essentially, the par value is the value that's one of the things that's on a bond, is the par value. How much is going to be repaid to the holder of the bond when the bond matures? Now, that's the other thing about a bond. The second part of the bond is what we call the maturity date. The maturity date is when the payment is made, when the repayment is made. That's the repayment date. So if you lend somebody money, you want to know when you're going to get repaid, and you want to know how much you're going to be repaid. When you get repaid is the maturity date. How much you get repaid is the par value. The other thing that's on the face of the bond is who is doing the repaying. In other words, This is who the borrower is. So you have the face value, what you get repaid, the maturity date when you get repaid, and the borrower's name, which is who is going to do the repaying. But notice what's not there. There are two things that aren't there. One is the interest rate, and two is who gets repaid. We know who is doing the repaying, but we don't know who is getting repaid. And that's because in the bond market is sometimes referred to as the secondary market. Bonds can be bought and sold. Bonds can be traded. Just like stocks can be traded. We don't hear a lot about the bond market and the bond trades because it's, again, sort of a boring thing. You're just trading one IOU. You're selling an IOU to somebody else. Not a whole lot of excitement there. Bonds can be traded, though, and they get traded in what's called the secondary market. How much they get traded for is determined by demand and supply. But demand is primarily based upon risk. So demand for bonds is often, well, it's determined by two things, risk and how much time before the bond gets repaid. But I want to focus on risk here. Because risk, as I mentioned before, determines the interest rate that's paid on the bond. And there are three types of risk. One is what we call the repayment risk. Just like you have a credit score that sends a signal to lenders about your credit worthiness, the lower your credit score, the less credit worthy you are. Well, businesses and governments also have a score, also have a ranking of how risky they are, about the repayment risk. But with companies and governments, it's not a number like we have as individuals, it's a letter grade. And the letter grade tells us what the repayment risk is. The repayment risk is based upon your past repayment history. So if you borrowed money before, as a company, have you paid it back on time? If you are a government and you have borrowed money, have you repaid it on time? And if you have a good risk rating, then you get to pay lower interest rates. A good rating in terms of risk means lower borrowing costs or lower interest rates. This is really good for the company. And it can be good for the person who holds the bond. It means that you're pretty sure that the company is going to repay you or the government is going to repay you. The better your repayment risk, the lower the interest rate. As you might expect, the more letter A's you get, the better. So a AAA rated bond is really, really good. This is what we sometimes refer to as prime lending rates. The borrowers don't have to pay a lot in interest, and the lenders don't have to worry too much about getting repaid. AA is pretty good. It's a high-rated bond. There is a little bit of risk with companies and countries that have a AA, but it's still, the interest rates are going to be pretty low with a AA. An A is okay, and BBB is starting to get a little bit worrisome. But all four of these categories are what we call investment grade bonds. These are pretty safe, pretty sure that you're going to get repaid. The default risk or the repayment risk is pretty low. Once you go below BBB rated bonds, so things get a little dicey. There's BB, there's B, there's CCC, there's CC, and then there's what we call junk bonds. When you get down into here, into these kind of categories, these are non-investment grade. These are much higher risk bonds. Junk bonds are bonds that are issued by companies that are on the verge of going bankrupt. You can make a lot of money on a junk bond, but the likelihood is you're going to lose all your money, because if these companies go out of business, it may be that you never get repaid. And that's one of the other things in terms of risk that you can differentiate between stock market and the bond market. In the stock market, there's lots of risk because there is no guarantee you'll get your money back. There's no guarantee with the stocks. With bonds, it's a little bit different. Bonds are contracts. And while you might not get all your money back if a company goes bankrupt, you do have a claim on the resources of a company if they go bankrupt. Bond holders may not get all their money back, but bond holders have a claim on company resources. So if a company goes bankrupt and has to sell its resources, some of the money that's going to have to be repaid to the bondholders. But the stockholders, you're just totally out of luck. Repayment risk, that's one of the types of risk. What's the risk of me being repaid? Is it a good risk or is it a bad risk? Good risks pay lower interest rates, bad risks pay higher interest rates. The second type of risk involves time. And this simply relates to how long is it till you get repaid? When do you get repaid? And the longer it takes to get repaid, then the more risk. Even very stable companies and countries, for that matter, can go downhill and kind of implode over, given enough time. A company like I picked on Sears a little bit earlier in the semester. A company like Sears, people would buy Sears bonds or Sears stock with the anticipation that that company would be here forever, and it seemed like they would be until they're not. There's more risk involved with a longer-term bond. With less risk, or with less time, there's less risk. So if the bond is a 6-month bond, most companies and most countries are going to be around in 6 months. So there's less risk. And anytime you have less risk, the interest rate goes down. The last thing I want to mention here in terms of risk is tax risk. Because interest is income, there's a risk that taxes could go up and erode the value of that income. So if your interest is taxable, and in most cases it is, there's a risk that taxes go up. There's a risk that the tax code can change. And if it changes, it devalues your interest income. But there are a certain kind of bond that avoids this tax risk altogether. That type of bond is called a muni bond. A muni or a municipal bond is a tax-free bond. In other words, you earn interest, but you don't pay any tax on the interest. It's entirely tax-free. And because of that, muni bonds have very low interest rates. So if you have a lot of money, if that rich uncle, instead of leaving you $1,000, leaves you like $10 million, a way you could earn perpetual tax-free income would be to put that $10 million to work in the municipal bond market. You're not going to earn a lot of interest for each bond that you hold. In fact, the interest is going to be really, really small. But it's all tax-free income. Well, that's pretty much it in terms of the loanable funds market. Those are the basic parts. And I know we didn't get into trading stocks or trading bonds all that much, but hopefully now you have a little bit better understanding of the loanable funds market as a whole. Remember, the purpose of the loanable funds market or the financial system is to get savings into the hands of investors. That is the most important thing to understand about this chapter. Because if you want your economy to grow, if you want to have new innovative products, businesses need to have the ability to invest. And they get that investment from savers. Of course, that can happen in a couple of different ways. You have the indirect way of the banking system, and then you have the direct way of the stock market, of the stocks and the bonds, where savers give their money directly to the businesses. What we're going to do now, or what we're going to do next week anyway, is we're going to turn our attention to the banking system and money, and kind of where does all this money come from, and who's in charge of it, and just how does that work? And so we're going to be talking about an institution called the Fed, or the Federal Reserve Bank, which is in the news today for, unfortunately, all the wrong reasons. I mean, they're doing the best job that they can, but the reason that they're in the news, of course, is because we want the Federal Reserve Bank to help us out of this coronavirus situation.